Welcome back to the channel, everybody. My name is Paul, and welcome to the #1 trend trading masterclass, where you're going to learn how to make money applying these basic concepts to your trading. Obviously, there's a lot of videos already on YouTube in regards to trends and trend trading, but one thing I've noticed is a lot of those videos are either generic, repetitive, or incomplete. And while those videos can be helpful to a point, they don't really teach you everything you need to know. So today's objective is to provide you with the information you need, which can enhance your experience and also help you identify profitable trade entries. We're going to cover a wide variety of topics, from how to draw your trend lines correctly, how to trade using trend lines, adding confluences for high probability entries, trading with the trends, but I'm also going to share with you some strategies that I actually implement to my trading, including the trend line bounce strategy, the trend line confirm strategy, and also the trend line breakout strategy. We're also going to talk about how we can use trends as a criteria for exiting our trades and minimizing our risk. But we're also going to cover some things that a lot of traders out there don't show or don't cover, and that is multi-time frame analysis and how that affects trends, trends within trends, and more importantly, live trading examples of my own personal trades, so that way you can see how to apply these methods that we're going to be going over today into a live trading environment, and more importantly, make money. Like I said, this is going to be the #1 trend trading masterclass. So sit back, relax, take some notes, like and subscribe if you gain any value. If you have any questions, comment down below. You can also reach out to me directly either via email or Telegram. You can access all of my official contact information down below in the video description, alongside with all of our trading resources provided, including links to free demo accounts of brokers I use, our VIP signal service where you can follow and copy my trades, our trading community, auto trading, much more. All of that can be found down below. But with that being said, let's get started with today's masterclass. So let's first actually talk about drawing trends, and more specifically, how to draw them correctly. This is important to understand because these trend lines that you're going to be marking up on your charts are going to represent opportune areas for your buys and your sells. Now, generally speaking, when it comes to trend trading, you want to follow the trend. In other words, if you're in a buyer's market, you should only be looking for buy trades. If you're in a seller's market, you should be looking for sell trades. This is very similar to the concept of swimming in a river. It is a lot easier to swim with the current rather than against it. So the trend lines that we mark up on our charts represent diagonal levels of support and resistance. And as we know about support and resistance, we buy at levels of support, we sell at levels of resistance. So in the spirit of drawing trends, we want to make sure that we are applying these trend lines on our chart correctly. In a downtrend, we have these peaks and lower valleys. The peaks are referred to as lower highs or swing highs, and the valleys are referred to as lower lows or swing lows. So when marking up your trend lines in a downtrend, you want to connect the swing highs. Why do we do this? Because in a seller's market, we are looking for sell trades. Where do we want to sell? At levels of resistance. Your trend line in a downtrend serves as a diagonal level of resistance, which means that your trend line represents areas of the market that are best for entering potential sells. Think of yourself as a store owner. As a store owner, you have products that you want to sell. In order to make a profit, you want to sell those items at a higher rate. So the concept of selling at a higher rate is applicable in trading. If you wanted to enter for a sell in a downtrend, do you want to sell at these lower valleys where the price is low? No, you want to sell at the swing highs where the price is higher, giving you an optimal entry for bigger profit. Now in an uptrend, we also have peaks and lower valleys. The peaks in an uptrend are referred to as higher highs or swing highs. The valleys are referred to as higher lows, which are your swing lows. Now, in an uptrend, we want to mark our trend lines by connecting the swing lows. Why? Because your trend line in an uptrend represents a diagonal level of support, which represent opportune areas for potential buys. So using a real world concept, as a buyer, right, as a consumer, when you go to the store to buy an item, it is best to buy an item that is on sale rather than paying full price. In other words, you want to buy when the price is low, and that concept also applies in trading. When looking at the structure of an uptrend, where's the best place to buy? At the swing highs? No, you want to buy when price is at a discount, at the swing lows. Looking at this chart, we are starting to see some bearish momentum, bearish structure, right? Prices creating lower highs and lower lows. So in a downtrend, we mark our trend line by connecting the swing high. So I'm going to start from the peak of this trend, and you want to set it where you can have as many touches as possible. As a side note, when I'm connecting my trend lines, I like to connect the wicks, not the body, because the wicks represent areas of the market where price tried to reach beyond those levels and then obviously were rejected before continuing its original trajectory. So just keep that in mind when drawing your trend lines. Connect the wicks, not the bodies. And you want to have at least 2 to 3 touches to make a valid trend line. As you can see, we have multiple touches here, here, marked by the wicks. These all represent opportune areas for potential sells. We have our trend line, which is our diagonal level of resistance. We buy at levels of support, we sell at levels of resistance. When we're in a downtrend, we like to sell at the swing highs when price is higher, represented by these touch points of our trend line. Now in an uptrend, we connect our swing lows. So just like what we showed you with the downtrend example, I'm gonna draw my trend line connecting the wicks, and I wanna make sure that I have multiple touch points to confirm that is a valid trend line. As you can see, we have multiple touch points here, here, and here. These all represent opportune areas for potential buys. Why? Because our trend line in a bullish market represents a diagonal level of support. We buy at levels of support. And because we're in an uptrend looking for buy trades, we want to buy at these levels at a discount when price retraces at the swing lows for better entries and higher profit potential. So to recap our topic of drawing trend lines, 2 to 3 touch points are needed for a valid trend line. In a downtrend, you connect the swing highs. In an uptrend, you connect the swing lows. Your trend line in an uptrend represents a level of support. Your trend line in a downtrend represents your level of resistance. Draw your trend lines by connecting the wicks for better zone clarity. And above all else, ladies and gentlemen, the reason why it's so important that we understand how to draw our trend lines correctly is because our trend lines are a guide. We use them to help us with our price analysis, representing optimal areas in the market for our buys and our sells, depending on the trend that we're in. However, we do not use trend lines as an exact rule for our entries and exits, which we'll cover more in detail in just a moment. But now that we know how to draw our trend lines, let's talk about how we can combine them with our price action for higher probability trade entries. How to trade using trend lines. So there's actually 2 ways that you can trade trends. You can either trade with the trends or you look for trend breakouts. Let's start off with trading with the trend, which, as I said earlier, if you're in a buyer's market, you're looking for buy trades. If you're in a seller's market, you're looking for sell trades. But more specifically, we're going to trade with the trend following the trend line bounce strategy. Here we have an uptrend marked by these 2 points. So again, you need at least 2 to 3 points to mark up a valid trend line. In efforts to use this trend line bounce strategy, we need price to come back and retest our ascending trend line as support. So as price fluctuates, price comes down, taps into our ascending trend line where we can enter for a buy. Our stop loss is going to be beyond this level of support, setting our take profit targets at either of these levels of prior resistance. As the trade plays out, this would have been a profitable trade for almost 600 pips. Here we have a downtrend marked by this descending trend line, starting from this point and connecting these points here, here, and here, which, as we stated earlier, your descending trend line can serve as a level of resistance. So at this point, we are waiting for price to retest our trend line once again. As you can see, we've now made contact, so we can enter for a sell position, setting our stop loss here at this point of resistance, and our take profit target set at this level of support. As the trade plays out, price went beyond our take profit target, allowing us to capitalize almost 300 pips from our point of entry. So to clarify, what we are showing you here is the trend line bounce strategy. You set up your trend lines and you wait for price to tap into your trend line zone. Once price hits that zone, you enter for the buy or sell depending on the trend that you're following, and you execute the trade. It's a great strategy adopted by a lot of intraday traders and scalpers, and it's one that I've incorporated many times throughout my trading career, including a position that we had taken just yesterday. Here's a trade that we took yesterday morning. As you can see, we have our ascending trend line. We waited for price to tap into our trend line. Once it did, we took a couple of positions. As price progressed, we waited for price to tap into our prior resistance level, closing the trade in profit for about 130 pips, which netted us a profit of over 13,000. Now, I will say that this type of approach using the trendline bounce strategy does open yourself to a little bit more risk. Just because price hits your trend line doesn't mean it's going to respect it and continue in its original trend trajectory. Case in point, using this downtrend example, here we have price coming back to our trend line once again. So based on the principles that we just went over on the trendline bounce strategy, most traders would assume, okay, well, let's enter for another sell. You set your stop loss and your take profit levels, only to realize price is now breaking all the way through, resulting in a loss. Breakouts are an indication of a potential trend reversal, which is something we're going to explain more in detail in a moment on how to trade trend breakouts. But before we get into that, let's talk about how we can avoid these scenarios from happening, or I should say not avoid, but in a sense, limit these scenarios to improve the overall probability of the trades that you take. And the best way to do this is by identifying confluences when you are waiting for price to reach your trend lines. So coming back to our uptrend, let's talk about confluences. We've already established that this was a profitable buy entry based off the trendline bounce concept. But because of the fact that trading is all about probabilities, there's no guarantee in trading. Markets at the end of the day are always going to do what they want to do. It is important that as traders, especially when trend trading, we identify other market confluences that confirm that most likely price is going to go in our predicted direction. To clarify, a confluence or confirmation are multiple factors that support our bias, whether we think price is going to go up or down. And these confluences make that area of the market a higher probability setup, where many other traders are looking at these areas, which leads to higher trading activity and stronger market reactions. In other words, more confluences that support your bias equals higher win rates. And specifically with trend trading, the best confluences you can identify are levels of support and resistance that align with your point of entry. Remember, trend lines are diagonal levels of support and resistance. If you can identify levels of support and resistance that align or complement your trend lines at your point of entry, this is going to increase the probabilities in your favor. Using this buy trade as an example. Why are we looking for a buy? Because we are in an uptrend. Price is going up. We are following the trend, and price is now seeming to respect our trend line. But before we take the trade, what other confluences can we see? All right, let's actually remove this, and I'm going to highlight this area, and let's go to a smaller time frame. From here, we can see multiple wick rejections. Every time price came down and tested this level, we have these long wicks that show signs of rejection. Where the sellers are trying to push price back down, the buyers are coming into play and ensuring that price remains above our trend. We can also see that if we look to the left, we have a level of resistance that turned into a minor level of support. And if we stretch this out, served as support here, and then served as support once again at our point of contact. This level of support is being respected, showing wick rejections and bullish price action from these candles. With price closing above our support, we can enter for the buy here, our stop loss beyond this level of support, setting our take profit targets at prior levels of resistance. We have another similar scenario here. Price came down, hit our trend line once again. But before we enter the trade, right, we want to identify what other confluences can we see that will solidify most likely price is going to continue upward for a buy trade. Well, if we look to the left, we have a level of support here, and if we stretch this out, aligns beautifully at our point of contact with our trend line. And then we wait to see if price is going to respect it. How do we know price is respecting this level of support? Look at this bullish engulfing candle. The closure of this candle shows that this level of support is being respected. So we enter for the buy here, stop loss below this level of support, with take profits targeting at prior levels of structure. So from these examples, I want you to take note of the confluences that we identified. The first confluence was the contact of our trend line. The second confluence were our levels of support aligning and complementing our point of contact of the trend line. And our third confluence are where the candles closed above our support. Whether you see long wicks or a bullish engulfing candle closing above your levels of support, these are both valid confluences of bullish momentum and respecting of that zone. Now you could also take it one step further by looking at higher time frames as another added confluence. You can see how we have these long wicks of rejection respecting our trend line complemented by the support. And here we also have another long wick respecting our trend line and support zone with the candle closure above the support level. Coming back to our downtrend, we've already established these were valid points for potential sells. But again, we don't want to enter these trades blindly. Some of the best levels of confluences when you're in a downtrend and you have a point of contact of your trend line is identifying levels of resistance that align with your zones. Case in point, here we have contact of our descending trend line. We're thinking price is going to go down. So what other confluences can we find? We already established that we have contact of the trend line. If we look to the left, what was a prior level of resistance turned to support, support here again, and then resistance once more. And if we stretch this all the way across, we can see that this level of resistance aligns with the point of contact of this trend line. And if we go down to a lower time frame, we have bearish candles closing price back below our level of resistance. So you could have entered here at the closure of the candle. Your stop loss beyond this level of resistance would take profit targets set at prior levels of support. And you could have also taken a second entry where price came up, retested that level once again, respecting it as resistance. Once we had the bearish candle confirming closure below the resistance, you could have entered for your sell here, support beyond this resistance, set and take profit targets at prior levels of support. And if we look at the higher time frames, we can see how the entries of both of these positions were placed beautifully in the midst of this bearish candle closing back below this resistance, our descending trend line, and our second position also occurred during the rejection of this long wick, further indicating bearish momentum. First level of confluence was waiting for contact of our trend line. Second confluence was identifying a level of resistance that complemented our trend line. And the third confluence was the candle closure below our resistance, indicating that that level is being respected, signifying further bearish momentum. This was a trade that we had taken last week where we had a minor descending trend line serving as a diagonal level of resistance, where we took a sell at this point, not only because it made contact of our descending trend line, but it also aligned with a level of resistance that was prior support. Because of the wick rejection at the point of contact of our descending trend line, indicating bearish momentum and respecting our descending trend line and that level of resistance, we took the sell, which as you can see, price hit our take profit target at 3296 for 130 pips and over $6,700 in profit. Here's another example of a couple of buys that we had taken during this uptrend. Price made contact of our trend line, where shortly after we took a couple of buy entries for the fact that not only did price respect our trend line, we have a bullish engulfing candle ensuring that price is going to stay above our trend line, but we can also see from our point of entries was a level of support that was also prior resistance. As a result of this trade, price hit our take profit target at 3428 for about 200 pips, resulting in a $10,000 profit from one trade and over $9,600 from our other trade. Now, there's another confluence that you can add into your criteria when trend trading, and that is the use of minor counter trend lines within the major trend. What do I mean by that? Well, coming back to our buy trade scenarios, we've already established our confluences of our support converging with our ascending trend lines. We have long wick rejections, bullish engulfing candles closing above our support lines, all of which are signaling bullish momentum for trend continuation trades, which is why we entered for these buys. But the other confluence you can add is a minor counter trend line within the major trend. What do I mean by that? Well, as you can see, the major trend is bullish, right? We've already established that, hence why we're looking for buys. But what you could also do, as price is retracing back to our ascended trend line, we can create minor counter trends. As you can see here, we'll start from this peak, connect this wick, and connect it to our major ascending trend line. We can also use this counter trend line as an added confluence to say, okay, if price is going to respect all these levels and also close above this minor counter trend, this is an added confluence confirming bullish momentum for our buy entry. And as you can see, the breakout of this minor counter trend line aligns perfectly with our original entry. Now, this method is not applicable in all setups. It will depend on the volatility and steepness of the retracements that you're currently trading. But looking over on this buy setup, if we were to apply the same concept of the minor counter trend line, we could either connect this peak with this peak and this peak, and then connected down to our major trend line. The candle breakout above this counter trend line does align with our entry. But depending on where you were to draw your counter trend, if you were to mark your trend line, let's say from this peak to this peak, which would then connect with this peak, connecting to your major trend line, our entry would actually be much higher. Instead of having an entry here, we'd be having an entry right about here at this candle closure. This is still a valid entry because we have a bullish engulfing candle closing above this level of support. So your entry would be at a higher price. It's still a valid entry where your stop loss would be here, but this is just to show you how, in addition to all the other confluences we've identified, you can use minor counter trend lines as an added confluence where you enter once those minor counter trend lines have broken through. Coming back to our bearish example, we've already established our confluences where we had price respecting our descending trend line, this level of resistance. We had bearish candle closures below our resistance, which is why we entered for these two trades. But if we want to apply the minor counter trend line, we could do that. So we'll take our trend line, we'll mark this pivot point, connect these 2 points until we reach our major trend line. So by adding this minor counter trend line, we would wait until price closed below the counter trend line for our entry, which, as you can see, is not far off from our original entry. Instead of entering at this point, we would have entered a little bit further down over here at the break and closure, which would have still been a valid entry. Now, if we look at our second sell entry, take our trend line, start from this pivot point, connect this wick, and then drag it to our major trend line. See how that lines up perfectly from the start of this impulse move, connects this wick and this wick. So if we wanted to use this counter trend line as an added confluence, we would wait for price to close below our counter trend line, which would be right around this level. Stop loss would be adjusted just a little bit, which, as you could see, would have still been a valid entry. So this is why trend lines are so powerful, because not only can they be used to determine the overall trend, but you can use minor counter trend lines as an added level of confluence for your entries. So as you can see, folks, the importance and the value that comes from identifying multiple levels of confluences. You don't just want to trade trends blindly just because price is hitting your trend line. I mean, granted, we showed you how that can be effective from the trend line bounce concept, but remember, trading is all about probabilities. Identifying other confluences that support your bias increase the probabilities in your favor. So to recap, when trading with the trend, set your trend lines and wait for price to reach your trend line zones. Look for levels of support and resistance with trend conversion. When possible, you can also mark up temporary minor trend lines for added breakout confluence within your major trend, and look for price action candles to confirm rejection from your support and resistance zones like long wicks, multiple failed rejections, and engulfing candles. And whenever you're in doubt, you can also check higher timeframes for higher structure confirmation. Finding confluences is extremely important because, for one, it helps avoid entering trades during a breakout like we showed in this example a few minutes ago. But more importantly, these confluences allow you to follow the trend, which enhances probabilities, looking for liquidity sweeps and taking advantage of trapped traders when entering the markets when they shouldn't. Using multiple confluences can lead to trade entries that yields a high reward with minimal risk. Now let's talk about trend breakouts, and more specifically, how to spot the breakouts and how to trade the breakouts. Breakouts are very important because these can signify potential trend reversals. So this is important because you want to make sure that you understand the differences between a true breakout and a fake out. A fake out is like the example that we had showed earlier where we had the uptrend and then price broke through our ascending trend line. Okay, well, the trend's broken. We're going to be looking for sells, only to realize price closed back above our trend line, hitting our stop loss for a losing trade while it continued its original trend trajectory. So we want to understand the criteria we need to look for to confirm that we're dealing with either a fake out or a true breakout. Coming back to our downtrend example, as you can see, we have our descending trend line connected by all of the swing highs, and we are starting to see price retrace back up to our descending trend line. And as you can see, we now have a candle closing above our descending trend line. So again, these types of quote unquote breakouts are created by the markets to fake traders into thinking this is a breakout where we're now going to see a trend reversal, traders placing their buys, only to realize price is now reversed, where in most cases your trade gets stopped out and you lose the trade. So the key you want to look out for here, folks, is confluence, right? Just like how we explained the importance of identifying confluences when placing your trades. You also want to look out for confluences when you are starting to see the formation of a break of our trend line to determine a fake out or a true breakout. What type of confluences should we be looking for here? Well, as we can see, price came up, broke up above our trend line, and then retraced back down. Why did this happen? Well, if we look to the left, we can see that this level, this little peak here, let's just remove this. These peaks align with prior levels of resistance here, here, and here. So if we were to, let's mark this level from our wicks, if we stretch this out, aligned with this wick rejection here, this resistance level here, and this wick rejection here, which also served as a minor level of support. So now that we know there's a level of resistance, what we want to see is price breaking above our resistance. And if possible, retest where price comes down, test this level, what was resistance, to now serve as support and continue in its upward trajectory, confirming a true breakout. So let's see what happens. Price goes on. As you can see, we have another wick rejection respecting our resistance. Let's keep going. Yet again, we have another wick rejection where price attempted to pierce through it, failed to do so, closing back below our resistance. Now, if you remember a few moments ago, we talked about the benefits of using minor counter trend lines within the major trend. As you can see, the major trend is down, right? We're in a bearish trend, but we can also see as price is attempting to break above our descending trend line and resistance, we have a minor uptrend formation. So at this point, we are waiting to see if price is either going to break above our major descending trend line for a potential trend breakout, or is price going to respect our resistance and continue downward? And if so, we would want to see price close below this minor trend line in efforts to target sells for a trend continuation. Let's keep going. Okay, so now we have a big bullish candle piercing and closing above our resistance. Not only did it close above this resistance, but it also closed above this level of resistance as well. Now, do we enter the trade here? No, because this candle is pretty big. If we were to enter here, our stop loss would be pretty far below this level. That's too big of a risk that we want to take. So like I mentioned before, not only do we want a break above our resistance, but we also want to see a retest where our price comes down to retest this prior level of resistance to now serve as support. So let's keep going. And there we have it. We have two bearish candles with long wicks. Remember, these long wicks signify rejection, where in this case, price tried to pierce below this prior resistance level, failed to do so, now serving as support. We could enter for the buy here, set our stop loss below this level of support, targeting prior levels of resistance for our take profit targets, whether it be here, here, or here. And as the trade plays out, price hit our take profit targets as a result of entering for a buy at a true trend breakout. Now here's an uptrend example where we have our ascending trend line. Price is now coming back to potentially touch our trend line once again. As you can see, price has now made contact of our trend line. Do we enter for a buy at this point? No, because we want to see if price is going to respect this prior level support, that was support here, and also resistance. Again, establishing the importance of confluence. If we had pulled the trigger and entered at this trade without any confluence, look what happened. Price, without warning, broke right through it. So if you had taken any buys, this would have resulted in a loss. Now, we have a closure below our trend line. Do we enter for a sell in the assumption that we are now seeing a possible trend reversal? No, because again, we want to wait for confluence. We want to see if price is going to either close back above this support and above our ascending trend line and continue upward, or price to retest what was prior support to then serve as resistance and then head back down for a true breakout. Price attempted to break above, failed to do so. So now our ascending trend line that once served as support is now serving as resistance. Not only that, but we also see our prior horizontal support, right? This yellow area, what was prior support is now serving as resistance. Not only did it fail to break above our ascending trend line and our prior support level, but it is now closing below the support, now serving as resistance. So we can take the entry for a sell, stop loss beyond the resistance, targeting prior support levels. As the trade plays out, you can see we had a bit of a retest here until eventually hitting our take profit target. Here's an example of a trade we had taken as a result of a trend breakout. We were in a downtrend for quite some time until we had the breakout, where eventually we took a buy position in this area of the market. Why did we take this buy? For a couple of reasons. We had a breakout of our trend line, which then later retested a trend line that was once prior diagonal resistance, now serving as support. We also had a prior level of support here, which served as support as far back in these areas as well. In addition to price respecting and failing to break back below our descending trend line and level of support, we can also see that it also respected our minor counter trend line. Because of the fact that price failed to break through these barriers, closing back above our trend line indicated a breach of the trend and a possible trend reversal. We entered for the buy. Eventually, price hit our take profit target at 37.80 for 300 pips and over $11,000 in profit. Now, keep in mind, when you're dealing with a breakout, you're not always going to get the break and retest as we showed you in those examples. There are times where price is just going to eventually blow through all of your levels and continue in that direction. Prime example, this actually happened earlier today. We have an ascending trend line showing that we were in an uptrend for several days. Up until earlier this afternoon, we had price come down, retouch our trend line, but then broke through. If we look at this at lower time frames, we didn't even have a retest of the zone. So just keep that in mind. The ideal scenario that you want to trade when trading a breakout is a break and retest. If you don't get the retest, don't put yourself at risk or put your money at risk out of FOMO. Step away and wait for another opportunity. So to recap, when trading breakouts, whenever you start to see price break out of a trend line, wait to see if it breaks any prior levels of support or resistance depending on the trend you're in. Once you have a break of a trend line and any prior levels of support resistance, wait for a retest for your entry to confirm that you're dealing with a true breakout and not a fake out. So at this point, ladies and gentlemen, we now have two more main topics that we want to cover, but I just want to give you all a quick shout out and thank you all for still being here, taking the time to watch this video. I hope you are enjoying it, and I hope you're gaining true value out of this masterclass. Everything that we were talking about are things that I learned over many years, so I'm happy to be able to provide everything I've learned into one video. With that said, let's move on and talk about how you can use trend lines for your trade exits. Generally speaking, let's say you wanted to take a sell in this area of the market, right? Your take profits should always be set at previous levels of structure. So in this case, if we are taking a sell, we want to set it at prior levels of support, such as, this support here. So we can set this here to align with this level of support, or these prior levels of support as well, right? Same goes for a buy. Just using this as an example, if we were entered for a buy trade in this position, our take profit targets would be set at prior levels of resistance, whether it be here or even here, right? However, in addition to using trend lines to help you understand what type of trend you're in and when there could be potential breakouts, you can also use trend lines as a guide for exiting your trades. All right. So what do I mean by that? Well, let's say we entered for a trade here. As price is fluctuating deeper in profit, okay, you can draw a trend line where you are aligning with the movement of the candlestick formation. So the rule here is, as long as price doesn't close above our trend line, we're going to continue to hold this trade. All right. So as price keeps going, we are heavily deep in profit until eventually we have a close above our trend line. Once you have the closure above your trend line, you would then close your trade. Now, obviously, this method requires you to monitor the trade, but this is a method I've seen many traders adopt. Personally, it's not something that I like to use. When I'm setting my trades, I like to set them at previous levels of structure. So like I said before, if I was taking the sell, I'd be targeting prior levels of support structure, such as here or here. So if I had taken this trade, I would have capitalized a big profit here. Whereas if we were using the trend line rule, then we would have closed our trade over here, right? So yeah, a little bit more profit, setting my stop loss at this level compared to closing it manually over here. But to each their own, there are pros and cons to either one. This will come down to your preference. In the case of a buy trade, if I wanted to enter for a buy in this area of the market, I could either set my take profit target to a prior level of resistance, so either this level of resistance or this level of resistance, or I could use the trendline rule where as my trade is fluctuating and I start to see a form of structure, I'll mark a trend line, and as long as price remains above this trend line, I'm gonna hold the trade. Once price closes below this trend line, I'll close the trade. As this plays out, all right, there we go. We now have a closure below our trend line, so we will close our trade manually at this level. Whereas compared to, you could set it here at this prior level of resistance or this level of resistance. Let's see if price would have reached this level. Price keeps going. There you have it, where price did break down below our trend line, but consolidated for a bit and then continued rallying back up. So if we had set our take profit targets at prior levels of resistance, such as here or here, we would have earned a larger profit compared to, using the trend line where we would have closed our trade at the break of our minor trend line set over here, right? So like I said, using the trendline method as a guide for when I should be closing out my trades is not a method that I personally like to use, but many other traders like it. Some of you might. So this is why I figured, since we are talking about trends, why not share this, giving you the choice of what methods you prefer to apply to your trading. I like to use prior levels of structure. Honestly, I think it's most recommended for obvious reasons. And of course, it is more widely adopted by other traders, but to each their own, it'll come down to your preference. Now, the last thing I want to talk about before we conclude this masterclass is the multi-timeframe analysis, specifically with trends. This is a very important subject to understand because how many times have you entered a trade because you wanted to follow that trend, only to realize price reversed, stopped you out of your trade, resulting in a loss, and where you thought you were in an uptrend, now you're in a downtrend, or vice versa, where you thought you were in a downtrend, now you're in an uptrend. A lot of times this happens because people tend to focus more on the smaller time frame trends without taking into consideration the major time frame trends. What do I mean by that? Well, coming back to our original trend structure diagrams, we already know this is a downtrend, right? Because we have lower highs and lower lows. We've connected our trend line to the swing highs, but what most people don't realize is that in the midst of this major downtrend, we have smaller trends. We have a downtrend followed by an uptrend, then a downtrend followed by another uptrend, and so on and so on. These uptrends are the retracements that create the swing high before continuing in its original trend trajectory, which in this case is a downtrend. In an uptrend, right, we know this is an uptrend because price is creating higher highs and higher lows. We've marked our trend line connecting the swing lows, indicating that this is an uptrend. But in the midst of this uptrend, we have minor trends. We have an uptrend followed by a downtrend, an uptrend followed by another downtrend, an uptrend followed by another downtrend. So we have these minor downtrends in the midst of this major bullish trend. So the problem that a lot of beginners face, they are trading somewhere in smaller time frames in the midst of this downtrend. Because this is a downtrend, they're looking for sells until eventually price reverses, right? We end up having a breakout of the small downtrend before the continuation of the major trend. Same with the downtrend. A lot of beginner traders in trading in this uptrend, they believe that they are in an uptrend, so price is going to go up. They look for buys only to realize price breaks out of the minor uptrend to continue its original trend trajectory of the major downtrend. And this is something you will see in any assets that you trade. Here we can see on a higher time frame, the overall structure, in this case we're looking at gold, is bullish. But in the midst of this major trend from a higher time frame, we have a lot of these small downtrends. Small downtrend here, here, another small minor downtrend here. And if we stretch back, we'll find more examples of these. Here we have, all right, another major trend line here. But in the midst of this major bullish structure, we have minor bearish structures or minor downtrends. So yeah, we have bearish structure here in the midst of this larger bull run picture. Okay, now this may not look like much, but if we were to narrow down to, you know, a smaller time frame, like let's say the 5-minute time frame, look how large these trends really are from a smaller time frame, right? It's not perfect. Don't worry about the fact that this trend line isn't drawn too perfectly. This is just for illustration purposes, but I want you to see, folks, how in the midst of this minor downtrend from a smaller time frame, there's a lot of trading activity. So there's plenty of opportunities to enter sells, but it's also important that you're mindful of the trends from a higher time frame. Because if you're trading in the midst of this downtrend looking for sells and you see price is getting close to this bullish trend line that we marked from a higher time frame, this is going to indicate most likely once price reaches these levels, price is going to bounce and respect that zone. Why? Because trends, support, and resistance zones are much stronger on higher time frames than they are on a smaller time frame. You'll find support, resistance, and trend lines in any time frames, whether it's the daily, the 1 hour, or the 1 minute. But those zones that you identify on the larger time frames are going to be much stronger than zones you find on a smaller 5-minute or 1-minute time frame. So just keep that in mind, because just from this somewhat sloppy illustration, this is our minor downtrend, but price is now bouncing off of this trend line from a higher time frame. Once we got that bounce, it pushed price up, breaking through our minor descendant trend line. And as a result, we got the break, retest, and then price continued upward, confirming a true breakout from the minor downward trend. So remember, when trading trends, make sure that you're also taking into consideration any possible major zones from higher time frames. And that way you can better estimate which zones are most likely to be respected, depending if those zones that you've marked are on a smaller time frame versus a higher time frame. Ladies and gentlemen, that concludes our masterclass. And I want to say again, thank you all so much for taking the time to watch this. I also want to say that when you take everything that you've learned from this masterclass and combine it with the information provided in our market structure video, this is going to take your trading to a whole new level. Remember, trading is all about probabilities. Mark up your confluences and then wait for price to come to your area. And if your confluences align with your bias, take action, take the trade. If you want to check out some of our recent uploads where we break down some of our strategies incorporating some of these principles, you can check out any of these recommendations, and we'll see you on the next one. Take care.